Dear students, welcome to lecture 1 of week 12, which is the last week in which we are going to focus on export risk and insurance. Today, we are going to discuss about a topic which is very important, that is export risks in the title. Today, we are going to discuss about an important topic, that is risks in export trade, and we are going to discuss its overview, that is all its important dimensions. Let us begin the journey. At the outset, let us go through the contents of the presentation and today's lecture. We will be starting with introduction and the concept of export risk, where we will try to explore that what lies and what needs to be understood about export risk. After that, we will try to understand importance of risk analysis in export trade. We all are aware that it is not just about understanding risk but analyzing how risk changes according to different situations. An understanding of risk thus becomes very important. Subsequently, we will try to discuss the classification of export risk. The different classification of export risk helps the exporter to identify when to apply which particular classification. Also, from situation to situation, the application of export risk may differ. Thus, we will be exploring these issues under this particular title. After that, we will talk about commercial and political risk. This is a type of classification of export risk, and we will delve deep into its differences and what are its importance. Followed by financial and exchange risk. The financial and exchange risks are very important for the exporter because the monetary perspective of export trade cannot be eliminated. Consequently, we will try to understand the transport and operational risk. These risks are very important because in export we know that goods are transported or transited from one place in one country to another place, that is destination in another country. Thus, with the understanding of transport risk, we will understand how exporters can manage their transport or logistics requirements. After that, we will try to discuss the market, legal, and environmental risks. These risks are associated with the business environment of the exporters, and thus their importance cannot be undermined. We will be exploring their relevance and their different dimensions. After that, we'll try to understand the interrelationship among different types of risk for an exporter. Risk cannot be isolated based on classification or categorization. Thus, it is very important that we try to develop the networking and understand the relationship between different types of risk. After that, we will try to focus on risk assessment and management framework. How to assess the risk and how to then manage the risk. These two are very important practical application of understanding of the risk. With this, the exporters can minimize the probability of the losses and may become more successful exporter. Thus, we will explore this in this particular slide, followed by role of insurance and institutional support in minimizing and managing the risk, followed by understanding the recent trends in global risk management for exporters, and after that we will have a summary as well as conclusion of today's discussion. At the outset, it is important for all of us as students of export import to appreciate the fact that whenever there is trade in terms of export and import, there are always uncertainties that are attached. These uncertainties are due to different reasons, but with respect to exports and imports, the primary or the basic reason is cross border trade. Cross border trade means that more than one country is participating in the goods, and because of differences in several factors such as economic factors, political factors, and social factors, there is always a possibility and probability of uncertainties due to different behaviors. Thus, these uncertainties in export import trade generates different types of risks. These risks are thus associated with political factors, financial factors, operational factors, and external factors which are beyond the exporter's control. The exporter can control only one type of risk, that is internal risk. However, the external risk generates through those factors which are not in the control of the exporters, because exporter has limited scope of control over the business activity. Whatever happens in the exporter's business can be controlled by exporters. Whatever happen outside the business of the exporter but has some kind of implication on the risk of the exporters cannot be controlled by the exporter. Thus, the focus on trying to control external risk is problematic. Then what is the solution? The solution is to try to understand and minimize these risks, which we can technically call as the risk management and risk mitigation strategies. Thus, we can understand that effective risk understanding is crucial for sustainable international trade, that is export import that continues without any major disruptions. Also, the exporter requires risk management strategies because these will ensure continuity of the export import as well as profitability and competitiveness in the global market. We all know that exporters are looking for sustainability, continuity of the business, sustainability of the business in the global market, and all these things can only be achieved when the exporters look towards risk management strategies, because these risk management and mitigation strategies tries to minimize the risk which relates to the external factor on which the exporter cannot have controls. Thus, with all these important points which we have discussed, we can identify how important it is to understand the conceptual framework of export risk and to identify the export risk and export management strategies. Let us now try to delve deep into meaning and nature of export risk. So, export risk refers to the probability of loss or non-performance due to the risks and uncertainties that arises in international trade activities. International trade is always characterized by uncertainties because of the complex business environment that is generated with the interaction of one or more than one countries. Thus, because of this particular thing, it involves exposure to financial loss, non-payment, delays, or legal complications. Because more than one countries are involved in the business activity, the legality of the business transactions always are questionable, and there may be any time some changes due to political regime changes. Thus, it is important to appreciate the point that export risks understanding is very important. Export risk also results from complex interaction among multiple stakeholders, for example, regulatory bodies, exporter, importer bodies that are associated with international standards, the different jurisdiction, that is the legal system of different countries, markets, or ports, etc., and the different currencies that are also involved in export import trade. Thus, if we see the matter of foreign exchange, that is involvement of different currencies, we can see with the fluctuation in the currency rate, the export risk will also fluctuate. Thus, the exporter has done nothing wrong, but because of changes in the market behavior, there has been some changes in the exchange rate mechanism between two countries, and that exchange rate may negatively impact the payment exporter's payment. Therefore, we know that it is very important to understand export risk and plan proactively for managing such kind of currency exchange risk or uncertainties. Also, risk can be anticipated, transferred, minimized, or insured, but it cannot be entirely eliminated. So, we are not saying that exporter can entirely eliminate the risk. There is no situation in which risk can be equal to zero for an exporter. It has to have some kind of value. It means always there will be risk for the exporter. But yes, it can be minimized. For example, if on a scale of 10, the risk for an exporter is 7, then there are different management practices and strategy through which this risk can be either minimized to 5 or 3, or it can be ensured that in case of losses, the benefit will be transferred from the insurance company. It can also be transferred to another organization or any subsidiary of its own. So all these steps and strategies can work for the exporter in minimizing and mitigation of the risks. But these can only be achieved when the organization, that is exporter, is proactively working to minimize and mitigate risk. Let us now talk about the importance of risk analysis in export trade. First of all, please understand what is risk analysis. Risk analysis is the process of identifying risk and its probable causes. It may also include the prediction of risks, and it may also include comparison of risk with the industry standards. Thus, risk analysis enables exporters to identify the vulnerabilities before contract execution. That is what we have said, process of identifying risk and possible causes. This is very important because if an exporter identifies those vulnerable areas wherein risk will be highlighted, then a proper study of the vulnerable areas can provide us the anticipated value or anticipation of the type of risk. And then proactive planning can minimize or mitigate those risks. The decisions can also be taken that what method should be adopted to minimize the risk. In addition to this, the risk analysis also facilitates decision making with respect to pricing. For example, if risk related to payment is identified, we can put prices a bit higher so that in case of any partial default, we recover maximum amount of the payment. Also, these can be related to insurance and payment terms because payment realization is a complex issue and therefore it involves banking as well. So, if there is more risk, the exporter can think of going with the bank guarantees (BGs) or documentary credits. What manner should be used, that can be determined by the exporter after analyzing the export risk. And similarly, insurance. What should be the insurance? Which stage of business needs to be insured? All this will be determined by identifying the different risks which are associated with different stages of the exporter. So this is very important. Not only this, the export risk analysis is also very important because it assists in selecting appropriate markets. It also includes understanding the risk which prevails in a specific market or the risk associated with partners or partners institutions. All this also provide a wholesome scenario of the uncertainties, and then the exporter may proactively plan for going into those markets with some specific strategies. Or if the exporter finds that the risks are quite high, they can drop the decision of going into these new markets and may continue doing operations in the old or ongoing markets. Also, it is to be noted that risk analysis in export trade strengthens resilience against global disruptions and economic volatility. The global disruption means that sometimes economic and political changes and events happens in the world that changes whole scenario of the market. Similarly, economic volatility is frequency of changing in the foreign exchange valuation. These two things are dynamic and they are the major characteristic of international trade and international markets. No organization can be safe from these dynamic changes. Every organization, every exporter has to deal with it. With the help of risk analysis, the exporter can better prepare to deal with these global changes and economic volatility. Finally, it will be justified to say that risk analysis in export trade supports compliance with international trade finance and insurance frameworks. Let us now try to understand the characteristics of export trade, under which we are trying to discuss most of the classification of export risk. Export trade is classified and characterized as per the risk which is being associated with it. So, in this characteristics, we are trying to identify and explore the different risks that are being associated with export trade. So we will start with the first one, that is commercial risk. Commercial risks are associated with the main business activity of the exporter. Thus, it includes the default by the buyer, that buyer has failed to make the payment, insolvency of the buyer, buyer has become bankrupt, or delayed payment due to one or the other reasons. The second type of risk are the political risk. These risks are associated with the regime or the government. Any political change in a particular country may result in some kind of changes in the policies. Due to certain political reasons, there may be bad relationship or no relationship between the two countries, which may further hamper the trade. Thus, political factors are also very important because they can generate immediate risk which can be hazardous for the exporters. The third type is the financial risk. These generally generate because of the economic and financial exposure of the exporters, such as changes in interest rate, changes in banks rate, inflation in an economy. So they can be termed as other macroeconomic factors that are associated with the operations of the exporter. Currency fluctuations will also come under this category. Now, because an exporter has to deal with the economy as a financial market, if there are certain changes in the financial market, the uncertainties in the financial market, that becomes the financial risk for the exporter. The next type of risk is transport or marine risk. Transport or marine risk are very important because they are also affecting export trade. We know that export we know that in exports one product is transferred from one country to another country. Thus, during the transition of the good, the transit of the good, transport of the good by any means, for example, by air, sea, or road, there are always possibility of losses or damages. These losses and damages create uncertainties, and that is a very important risk for which the exporter should plan things such as insurance. The next type of risk is the market risk, which includes price volatility, demand fluctuation, or competition. Market risks are associated with the market in which the exporter is exporting goods, particularly the destination markets, because the get bec- because the goods has to serve the customers of the destination market. For example, if goods are being exported from India to UAE, then the destination market is UAE. Therefore, the goods are going to UAE for the consumers of the UAE. Thus, the market risk in this case will be the risk associated and the uncertainties associated with UAE market if the goods are not being re-exported to any other country from UAE. This is the meaning of the market risk. And there can be differences in the pricing because prices may change because goods from other parts of the world are also entering United Arab Emirates. There can be demand fluctuation based on what consumers want or competition between different exporters to sell their goods in the market. The next type of risk is the legal and regulatory risk. Legal and regulatory risks are also very powerful because they can hamper the exporter's reputation as well as create lots of legal complications for the exporters. They generally refers to the uncertainties that emerge because of breach of international laws or domestic laws as well. The last type of risk is the operational risk. These risks relate to the operations of the exporter, such as documentation, logistic, or internal processes. When these things are not properly managed, failure of these things or if the efficiency and effectiveness of these things are poor, then in those cases they may generate certain uncertainties and risks which are known as the operational risk. If operational risks are not properly handled, then the venture, that is exporter's business, may start incurring losses in the production and processing process as well. Let us now try to understand each risk separately. The first type of risk is commercial risk. Commercial risk arises from the buyer related or contractual failures. If buyer becomes default or if the buyer has become insolvent or there is delay in payment, then these risks comes under commercial risk. The common examples of commercial risk include non-payment, delayed payment of by the importer, that the importer has denied giving payment or has delayed payment to such an extent that it has become irrelevant and a source of loss to the exporter. Similarly, another example is cancellation of order before the shipment. So the buyer or the importer has cancelled the order in the last minute. Similarly, refusal to accept goods on arrival, which is a major risk and loss, that goods has arrived the destination country's port, but the importer has denied to receive them. And finally, insolvency or bankruptcy of the buyer, that is importer. Thus, typically, mitigating these risks comes through credit assessment, insurance, as well as secure payment methods. The second type of risk are political and country risk. Political and country risk emerge from government actions, or instability in the buyer's country. Again, these pertains to the destination countries. So, for example, if exporter is in India and importer is in Sri Lanka, then the different political situations that are arising in Sri Lanka will come under the political and country risk. These includes war, civil unrest, revolution or coup. We have seen that in Sri Lanka a few years back there was a revolution as well as civil unrest, and because of which trade was affected. And third, restrictions on remittances on foreign exchange transfer. So, if an exporter is selling goods to Sri Lanka at the time when there was upheaval and civil unrest, obviously the government had put some restrictions on the foreign exchange transfer. So, this generally happens, and this is the political and country risk. The third type is, or the example is, expropriation or nationalization or foreign owned asset, where the foreign assets are considered to be converted into nationalized institution. And finally, sudden changes in trade or import policies. All these type of risks, that is political and country risk, affect payment realization despite the willingness of the buyer to pay. The next type of risk is financial and exchange risk. Financial and exchange risk occurs due to adverse movement in exchange rates or financial markets. Let us go to the examples. The first is depreciation of importer's currency, which can reduce the payment value. The second is volatile interest rate, which also affect the credit cost. And finally, liquidity shortages can also happen, which can delay the payment settlements. Thus, currency hedging and financial instruments are often the solution to mitigate and manage such kind of risks. The next type of risk is transport and transit risk. These type of risk involve loss, damage, and theft of goods during the transport process. The mode of transport may be air, may be sea, or may be through roads. This can occur due to different natural causes or some human error as well. Thus, these type of risks are very important because they ultimately cause a huge loss, that is loss of the product itself. Thus, insurance is one of the solutions for mitigating or managing these transport and transit risks. Their coverage usually falls under marine or transit insurance policies. Thus, exporters must properly ensure that their transport and transit risks are properly managed, and they have adopted the mitigation strategies for the same. The next is market and demand risk. These risks stem from the changes in the global market conditions, and these include fluctuations in international prices or demand. Also, they include entry of new competitors or subsidies, as well as followed by different trade restrictions, tariffs, or consumers' preferences shifts. It is to be noted that this market and demand risk can be strategized or minimized with the help of market research and diversification strategies. Let us try to move on to the next one, that is legal and regulatory risk. These risks arise from violations or changes in trade related laws as well as the standards. We have seen in our course of learning that how important is the legal system and the international standards, and it becomes very important to follow them. These include examples such as non-compliance with import regulations, standards, or documentation norms. Not only this, they include the breach of contract or disputes that arise over different jurisdictions. Legal and regulatory risks are also caused due to changes in customs, taxation, or export control policy. There are different strategies to be used in legal and regulatory risk, and one of them is to always try to have good documentation. Let us now move, Dear students, let us now move on another type of risk, that is operational and internal risk. These are these risks are actually related to business itself, that is the exporter's organization or its own logistics network. The examples of these type of risks include poor documentation accuracy leading to problems in payment, then production delays or quality non-conformity, that is, whatever quality has been promised to the importer, the output is not matching that particular quality. Similarly, human error in export processing or contract execution also falls under operational risk. These operational risks can be managed or mitigated through a process of standardization, quality control, as well as quality assurance and digital tracking systems. Let us now try to see the environment. Let us now try to understand the environmental and force majeure risk. These risks are linked to unforeseen natural or external events that are not in the control of the business. These include extraordinary. This force majeure means extraordinary events. You can see over here it is written. These include earthquake, floods, pandemics, natural disasters, etc., which comes promptly without any notice, and that's why they are an extraordinary event. No business can expect regularity of these events. Thus, they may disrupt production, shipping, or the contractual performance of the exporters. Thus, contracts often have this particular clause of force majeure, which is instilled into contracts to safeguard both the parties in such events which are extraordinary in nature. The way to mitigate or manage environmental risk is to go for insurance, which can help to minimize the losses of both the parties. Let us now move on to interrelationship among export risks. Export risks are often interconnected and cascading. For example, political instability leads to payment delay, that is, payment will be delayed because of the political instability, such as civil unrest, such as coup, revolution, etc., which will ultimately lead to financial loss of the exporter, though there may be willingness of the buyer to pay, but because of political circumstances and certain restriction, the buyer has failed to pay, which will result into financial loss. Thus will lead to the contractual breach between exporter and importer, generally by the importer. So we can see the cascading effect of export risk and the interrelationship between different types of risk. So a political instability, which is a political risk, has converted into financial risk. Another example, for example, if there is a documentation error, which is an operational risk, then there will be regulatory non-compliance and which will reject and which will ultimately lead to banking rejection. What means there was an operational risk which transformed into a legal risk, which ultimately transformed into a financial risk. So you can see how these risks are interconnected. Thus, effective export management requires a holistic, integrated risk management approach. Thus, there is a requirement of coordination among finance, logistics, legal, and operational teams in export processing. Let us now try to focus on measuring and assessing export risk. Risk assessment involves evaluating certain parameters such as the probability of occurrence, such as the magnitude of potential loss, how much loss we can expect, the controllability or mitigation of the scope, how much loss or risk we can minimize to what extent. There are different tools which can be used to assess the export risk and to measure it. We have country risk ratings and credit reports by different credit rating agencies. We also have this sensitivity and scenario analysis, where different scenarios such as boom, such as growth, just such as recovery, such as slowdown can be imagined, and based on that the probability scores can be calculated. We also have another way of the SWOT analysis, that is, which stands for strengths, weaknesses, opportunities, and threats. So any scenario can be divided into these four, and after comparison, we can see what are the possible strategies that can be adopted to assess the export risk. And finally, risk mapping can also be there. Thus, the quantitative evaluation of risk supports strategic decision making in risk, such as in trade finance. Let us now try to understand risk management and let us now try to understand risk management framework in export trade. Exporters adopt systematic frameworks to identify and mitigate risk. These include several of the things. The first is risk identification. This means detecting the potential exposure. Exposures can be economic exposure, social exposure, or political exposure. Then the second steps comes of risk evaluation, where risk is evaluated. And technically it means assessing of probability and the impact, the expected impact. The third way is risk mitigation, that is to apply preventive or protective measures. Preventive measures is taking proactive steps, and protective measures are safeguarding towards the loss, such as insurance. And the fourth important thing comes the risk monitoring, which is regular review and update of the controls that can help to mitigate risk in the exporter's business. Thus, we can learn that integration of risk management with export policy, finance, and insurance mechanism is essential for a successful strategy of mitigation of the risk. Let us now try to discuss the role of export insurance and government support. Export credit and insurance mechanism safeguard the interest of the exporters from different types of risk and non-commercial losses that emerges during the course of trade activities. There are institutions like ECGC and export credit agencies that provide assistance in this manner and offer different services such as credit risk insurance, political risk cover, buyer default protection, and the financial guarantees to banks. Let us now try to understand the contemporary, that is modern risk landscape. The modern exporters face risks which are quite global in nature because the world has become more integrated and international trade is more about integration. Thus, the global risk factor which applies to every country are more applicable now in comparison to the previous times. Thus, we here will say here we will see some kind of global risk pattern. One is the cyber security threats and the digital fraud. With the rise in technology and integration of technology across country, cybersecurity has become a big problem, and digital fraud is what exporters also has to deal with. The second thing relates to sanctions compliance and geopolitical fragmentation. The sanctions compliance is also a problematic issue because there are certain countries as well as institutions that can put sanctions on countries if they do not follow certain rules and regulations and even sometimes their whims and desire. For example, United States of America has put several sanctions on Russian Federation, Iran, etc. Similarly, the geopolitical fragmentation, the world is still divided into a developed bloc and a developing country bloc. Also, it is divided into North bloc and South bloc, Because of these geopolitical divisions also, there are certain risks which are quite relevant. The third is supply chain disruption and global logistics crisis. This is also a geopolitical and global phenomena which needs to be properly addressed. And finally, because of ESG screening, that is environmental, social, and governance, the risk factors are also increasing in trade finance. Thus, it is very important to adopt a strategy to integrate technology, but there is also need for exporters to deal with such kind of global risks associated with exports. Dear students, let us now conclude whatever we have discussed and learned in today's discussion. We have learned that export risk comprises and encompasses all uncertainties that may affect trade performance negatively. In addition to this, we have also learned that risks are multifaceted, such as commercial, political, financial, operational, and environmental. There is a need that exporters should comprehensively understand the different forms and foundations of risk so that they may adopt strategies for risk mitigation. In addition to this, proactive risk identification and management are indispensable for global trade success. Thus, in a nutshell, we can justify and say that mastery of export risk principles ensure stability, compliance, and global competitiveness for the exporters. Dear students, thank you very much for being with me in this session.